Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition where we're going to be focusing on decoding the RBI policy that's upon us. Remember, as expected, there is no repo rate cut, but a CRR cut has definitely happened as was the street's expectation. So the Monetary Policy Committee, with a majority of 4:2, has decided to keep the key rate, the repo rate, unchanged at 6.5% for the 11th consecutive meeting. They've cited concerns over inflation and the uncertain growth outlook as well. Remember, the RBI has also maintained its neutral policy stance, and what we've seen on two major important points, on the GDP and on inflation. Those are important points for you to understand. So the GDP growth estimate for FY25 has been lowered to 6.6% from the earlier estimates of 7.2%. For Q3, the GDP is estimated to be at 6.8% and 7.2% for Q4 is what we are given to understand. As far as the CPI inflation is concerned, over here as well, we've seen a tweaking of the forecast earlier. It's now pegged at 4.8%. It's been revised higher from the earlier estimate of 4.5%. Now, what the governor has highlighted and underlined is the persistent challenges in balancing inflation and growth. On the CRR, the cash reserve ratio, that's been slashed by 50 basis points to 4%. This is expected to inject 1.16 lakh crores into the banking system as well. So those are the important points that we've come to know. But joining in to decode the fine print of the RBI policy, I'm now joined by two very special guests on the show. Ms. Aditi Nayar, the Chief Economist at ICRA, is now joining in. Warm welcome to you, ma'am, and good afternoon to you. We're also joined by Mr. Madan Sabnavis. He's the Chief Economist of Bank of Baroda. Warm welcome to you, sir, as well, and thank you so much for taking the time out. Aditi, starting off with you, your first key takeaways, is it on expected lines, and especially when it comes to the projections, when it comes to the GDP and inflation, are you okay with the kind of projections that are coming in, more realistic to the reactions that we've so far seen in Q2?
CPI inflation having gone up to as much as 6.2% in October. The timing just wasn't right. The optics just weren't right to go in for a rate cut, despite the GDP growth having come in so much below expectations, ours as well as the MPCs. So from that point of view, first of all, no surprise that
inflation will come down to more acceptable levels in the fourth quarter of the year. Now, this particular thing of CRR cut, I think, has come as being very useful for banks because currently we have seen that there has been a bit of volatility in the market. We have seen the system in deficit last week. Now we're back to a marginal surplus, which is there. And we do think that during the course of this month, there would be the advance tax payments, the GST payments, and towards the end, there will be this rush for credit also. So there will be pressure on the banking system. So it's been quite fortuitous that the RBI has decided to lower the CRR rate, and because we're going to have one tranche on 14th December, the other one on 28th December, just at a point of time when money would be going out of the system. So I think this has been a very big positive for the banking system. And also from the point of view of deposit holders, I think they can assume that rates are not going to go up any further. Maybe at the margin, depending upon the asset liability mismatches or matches which are there for banks individually. Banks could be tinkering with certain rates. But on the whole, I think on a generalized basis for the banking system, I think the rates have definitely peaked. And now they'll only be moving in a downward direction. Though a lot will also depend upon when the repo rate is going to be reduced. Now, just some impression on the overall policy, I think, which I would like to make is that for the very first time, the RBI has actually started off with a preface of saying as to what is the main target of the Monetary Policy Committee, which is to target inflation. Otherwise, in the past, it was generally assumed that this was so, but because there has been a lot of high decibel levels on reducing the repo rate because growth came in at an unsatisfactory rate. I think the RBI has clarified this. But I think the interesting point here is the last point which I would make here is that this time there are 2 out of the 6 members who actually voted for a repo rate cut. Now, the only question or the apprehension I have is that even in the month of February when they meet, you're going to have 2 inflation numbers above 5%. Now, would it actually be feasible for the members to vote for rate cut when inflation is still high? Of course, RBI, the governor has mentioned that you also look at future perspective rather than current inflation only. So that could be the basis for lowering the rate. But I think the kind of conundrum which was there today saying that I have 5.5, 6.2, I'll still have 5.5 probably in the next 2 months. It'll be a similar kind of situation for the MPC to take a call.
Important point right there. Let me bring in Aditi on that front, since you also said that February rate cut is now likely. But given the fact that the inflation is still as far as the projections go, still above the comfort there, how would you really look at the kind of quantum that we could expect? Will it be absolutely a shallow rate cut?
So, Sakshi, just to extend what Madan was saying further, when we look at the projections that the RBI, the MPC has given today, the quarterly projections for the CPI inflation, they are looking at the CPI inflation moderating to 4% in the second quarter of FY26.
Yeah.
Now, if there are no risks that pop up which actually threaten this trajectory, then perhaps February could be high likelihood of a rate cut looking ahead. And for FY26 as well, our sense is that the GDP growth will come in around 6.5%. So we're looking at 2 consecutive years of a 6.5% GDP growth. And our sense at ICRA is that potential GDP growth is 6.5 to 7%. So it's not as high as what we've been reading of late. So 6.5 is still at the lower end of that range. And if there are no risks that threaten this awaited elusive sort of moderation in the CPI inflation down to 4%, then that could definitely be a possibility. Having said that, we don't expect there to be more than 50 basis points of rate cuts anyway. So a very, very shallow cycle, Feb, April, or maybe April, June, something like that. Not a very deep, cycle in any case.
Okay. Mr. Sabnavis, how about you? What is the expectation? Do you think, would you also pencil in a rate cut in February? And if at all that is the case, then what is it that you're penciling at?
So actually, the basis on which I'm saying that there could be a rate cut in February is only because if more and more members of the MPC are moving towards a rate cut, because in the last policy, one of them wanted a rate cut. Now we're saying two of them. So it's just a matter of time before there'll be three of them or maybe four of them. We're not quite sure. But otherwise, I think that inherently the Indian economy is one which has inflation in the region of 4.5 to 5%. So even for next year, if you're going to ask me for my projection for inflation, it's going to be 4.5 to 5%. And unlike Aditi, we are a bit more optimistic when it comes to GDP growth. We are looking at potential growth more closer to the 7% range. So I think with growth being more or less on this particular path of say 6.6, 6.8 is what we have for this year. It's maybe 7% next year. And inflation is going to be a challenge for us all through because we have the MSP, we always have a tomato failure, we always have an onion failure. And also we're looking for core inflation. I think the RBI this time has mentioned, and the governor has mentioned in his speech, that even if you look at manufactured products, you're looking at the service sector products, I think the costs have gone up and there is definitely a case for saying that even core inflation is going to start moving up. So I think now the call on rate is going to be taken more on the basis of how six members feel. It may not strictly go by the book saying that I require to have a 4% number or a 4.5% number. I think that's the sense which I'm getting.
Okay. So, Mr. Sabnavis, since you said that, you're more bullish, I think closer to 7% is what you expect on the GDP number as well. What is it coming from? Because we've seen a sharp reduction to 6.6% from RBI. Second half, they still expect, improvement. But even then, the projections are not that reflecting or gung-ho, when we talk about the second half projections from the RBI as well. Do you think the hinge factor will be, again, the government capex that slowed down because of the elections that may pick up? What is it that you are penciling in?
See, if I'm looking in terms of the sectoral growth, I think I'm expecting a better performance coming from the industrial sector. So currently we have seen that whenever we've had this uptick in growth, it's being contributed by services. And again, we're assuming that agriculture is normal monsoon. That assumption always holds. But I think I'm expecting a turnaround to happen more on the manufacturing side. And that is premised on the fact that there is going to be a pickup in terms of private consumption expenditure. That is something which has also been fairly volatile. At times it's the rural part doing well. Sometimes it's the urban part doing well, or neither of them are doing well. So I think the recovery in terms of consumption and a greater pickup in terms of private investment outside the infrastructure space. So today, if we look at the private sector investment, it's taking place in sectors which are linked to government capex. If I'm going to divorce the two and say, okay, is private sector investment going to take place in the non-heavy industry sector? That is where I expect it to pick up in the next financial year. So that's why I think the growth will be in the region of 7%, or maybe a little more than that. And if you go back to the last decade, that is 2010 to 15, when we had the big push given to investment, the Indian economy appeared to be an economy which could grow in the region of 8% plus. So we are still far away from that. So even when I say 7%, I think 8% is something which we need to do. So whenever we talk of 10 trillion economy, 30 trillion economy, or whatever these concepts
Yes.
are, we
Yes.
necessarily have to get to the 8% mark. 6.5%, 7% will definitely not get us through. So even 7%, I think, is just moving one step ahead before we reach the final mark of 8%.
Point there. Aditi, coming to you as well, we do know that India's potential could be upwards of 7.5 to 8%, and we are right now slackening at around 6.5%, as is the expectation. What is your own outlook on both the government as well as the private capex? Both have slackened. By when do you start seeing one, probably ahead of the other and pulling up the, string from there?
So, just want to respond to a few points. Firstly, we are looking at three major reasons that will support a turnaround in GDP growth in the second half of the year. One, as Madan pointed out, within industry, there were two sectors which were really doused by the heavy
Yes.
rainfall. That was mining and electricity. So that led to a transient headwind, which will now go away. Secondly, government capex, the headroom left for growth in the second half of this year is stupendous. It's around 61%. Certainly, I don't expect it to be achieved. But even if we have a 1 trillion shortfall compared to the budget estimate, the YOY growth for government capex in H2 will be huge. And that would push the GDP growth. Third, of course, the way things are set up for the rural economy, barring the fact that we do have this tendency every year to have a vegetable price shock. Like, let's leave that aside. But if
Yeah.
you look at the crop side of things, where we are with reservoirs, etc., with the Kharif output, with Rabi sowing, my sense is that now the rural sentiment will have a more sustained uptick. And that's generally good news in a scenario where urban demand is extremely uneven. So we have pockets of high demand, but we also have pockets which are very troubled by inflation, and especially food inflation being where it is, right? So that's a mixed kind of a scenario on the consumption side. Government expenditure, we're quite positive. For private capex now, we have multiple things to consider. The fact that domestic consumption is going to possibly be uneven for some time, but also the global situation is quite uncertain. So, in some sectors, the threat of tariffs, etc., may actually again lead to decisions not being taken to go ahead with private capex, and we may not see a very large pickup in private capex from kind of where things are right now. In the global context, I think 8% growth is really difficult on a sustained basis right now. I don't think exports are going to be supportive enough over the medium term to be able to take us there.
Okay, fair enough. Let me get in, Mr. Sabnavis there. Especially the governor did point out to the slowdown in the domestic activity also somehow bottoming out. He did say that there are signs in the rural economy and the demand right there. The agri growth is also pointing out towards good. Will it be able to mitigate what we are seeing in the urban consumption area, what Aditi was referring to? Do you see that happening anytime soon?
See, it can happen in terms of a limited amount of substitution which could take place. Because if we actually look at stratify the entire society, there's urban, rural. Within urban, we have the very rich who haven't really been affected by inflation. However, they have run into a problem of saturation of demand. You can't keep having 2 or 3 BMWs. You'll be happy with one, and then you'll have to wait for a couple of years before you buy another one. So I think that is one major problem which we have, that when the rich or the affluent keep consuming, there are certain periods where you see it build up, and then there's going to be saturation subsequently. If you're talking about the lowest level, I don't think there's much happening out there. They really don't have the purchasing power. So if I look at all these Swiggy and Zomato delivery boys who are there, they're hardly earning anything. They're working from 6 in the morning till 12 in the night, maybe earning 1,000 rupees a day. That cannot really keep them sustained, cannot really add to demand. So it's a middle section which we have seen, which have been affected by inflation, which is reallocating their resources. Now, interestingly, what we found is that there is a lot of pickup in terms of services. Even this middle class, they are doing a lot of travel. There's a lot of tourism going on, going to restaurants. That kind of thing is still happening. However, when it comes to buying goods, that is something which has gotten constrained. So the theory here is that in case inflation comes down, and in fact, when we say inflation comes down, we should remember that prices are still going up. It's not to say that prices are going down. But when this inflation level comes down, when your salaries or your wages keep increasing at a more than commensurate rate, then your purchasing power comes back. So then it's a case of saying I spend less on food items and I could be spending more on discretionary consumption. So I think it's going to be a kind of a slow kind of a process which takes place. Rural will support today when a time when maybe urban is not fully spending, but there are limitations out there. We should remember that farmers don't earn that kind of income where they can actually be buying cars and what you call these consumption goods in a very big way. It can happen in a limited manner. It has to be all encompassing, which will not happen in 1 or 2 years' time. We need to create more jobs. We need to have higher incomes. I think all our companies where we work in, your companies have to pay you higher salaries. Only then will you be in a position to spend more.
Fair enough. Since you talked about the farmer space, I think the government has also in the additional measures announced that they've upped the collateral agricultural loan limit as well to about 2 lakh rupees per borrower right there. Is that substantial to get the credit cycle going right there in the positive zone, Aditi?
I think Madan may be in a better position to answer that than me. I'm just going to go back to one point that I missed earlier. For next year, our CPI projection is also a little lower than Madan. So not only growth, but we're a little lower on the CPI inflation as well. I think that's
You're at
internally consistent.
4.8.
So we're at around 4.2% for next year,
Okay, for next year.
barring any
Okay.
major shock. So this is just baseline, and of course, in the current global environment that we're in, baselines can get upset very rapidly.
Okay. So, Mr. Sabnavis, how about you? How are you really looking at these additional measures that were taken in by the governor?
No, I think this will be kind of a baby step where you're providing a little more income, a little more loan. But at the end of the day, it's going to be a loan. So it's helping the farmers probably for their personal consumption, where you're getting this collateral-free loan of a higher level. But at the end of the day, it has to be serviced. So I think it's not going to be it's obviously an opportunity for both the farmers as well as banks to increase loans as well as take loans. But I'm not quite sure whether this is really going to add to overall consumption. That's going to come in case your harvests are good, you're getting a good income. So output minus multiplied by price, if you get a much higher income, that's when the spending really takes place.
Okay. And what about the FCNR B deposits as well? Do you think it's going to be also going to be easing some pressure on the rupee as well? Is that something that you are expecting? Mr.
This is for
Sabnavis.
you. For me? Okay. No, if
Yeah.
you look at the FCNR deposits, see, actually, we should look at the way. See, the RBI has opened the door saying that you can you can pay a higher interest on deposits. Now, banks will do it only in case they find use for it. Because just assume that I'm paying 5% on a deposit, say, in the US, and now I'm allowed to pay, say, 6%. Now, if I'm going to pay 6%, I should be in a position to deploy those funds. So if I don't have funds for deployment, I would not like to pay a higher deposit rate. Now, again, I'm not quite have the numbers with me, but I believe that most banks have not even touched the ceiling of what is being permitted right now, because you work on the basis of your own profitability, both for your overseas territory as well as for your domestic territory. So only to the extent that you're able to pay a higher deposit and deploy it in terms of foreign exchange loans, which you're giving at a profitable rate, only then would it make sense. Because if you're going to convert it into rupees by selling the dollars to the RBI, and then you are running the risk, of course, of the forex currency risk, which I don't think banks would like to take. So we need to
Correct.
wait and see. I think from the point of view of RBI, they've opened the door saying you can pay more if you want it. But each bank will evaluate about their own requirement before they go in for it.
Okay, got that. Aditi, I'll come to you to the bonds as well. Not much reaction was seen right after the policy over there, although the rupee just strengthened a little bit. What is your own expectation as far as the India 10-year paper is concerned? Looking at what's happening globally, US as well as China, what is it that you're expecting for India?
I'm not surprised that there wasn't much reaction because we'd seen the reaction coming in already after the GDP growth came in so much lower than expected. And despite that, I think the market was mostly very, very, clear that there was not going to be a repo cut today. And from the CRR point of view, we did expect it to be moving the bond yields in any case. Same thing with the FCNR, I think that's more of a signal that going ahead in the current global context, the INR is also going to be important. So within our flexible inflation targeting, we look at inflation and growth. But going ahead, possibly we will see a little bit more of signaling coming in, related to the INR as well. My sense is that the yields are now going to take a cue from the next two CPI inflation prints, possibly not much movement from the domestic side. The main cue now will be the CPI inflation print, not just for November, but more importantly for December, and whether that's going to allow for a rate cut to come in February or not. And of course, what happens with the Fed, how the expectations of Fed easing through 2025 change, that is something that will impact yields globally.
Okay, got that. When we talk about the liquidity space as well, of course, the CRR, cut that's been announced, that actually takes care of the current situation. But again, the kind of statements that were given is that liquidity is expected to be tight even going forward from there. So, Mr. Sabnavis, what else needs to be done on the liquidity factor from the governor?
See, if you've seen the stated policy of the RBI is that they have the LAF facility or the new liquidity framework where you use VRR and VRRR in order to even out liquidity. So I think that is something which is going to continue. So I think the timing of this CRR cut has been such that the RBI probably has already been contemplating it ever since we went in for a neutral stance. We haven't actually done anything for the system. So maybe the CRR was a logical corollary step to take post changing the stance. The second is, as what the RBI governor has mentioned, is that 4% was the normal repo rate. So when it went up to 5%, that was after the Ukraine war. So they had to roll it back at some point of time. So this turned out to be an opportune time, but there were already problems in terms of liquidity. So I think going ahead, we may not be expecting any more CRR cuts. It will continue to be the VRR and VRRR, to which surpluses and deficits will be handled by the RBI. In fact, we also felt that another option would be open market operations, but I think that also doesn't seem to be much on the table. So I think going ahead, I think liquidity will continue to be balanced through the LAP facility.
We are closer to winding up now our discussion, so I'll come for closing comments to both of you now. Anything that was left as something that should have been touched upon in the policy and was not touched, what is it that you now expect going forward? And also one comment on, do you expect Governor Shaktikanta Das to continue and get that extension?
I don't think you have enough time for us to comment on that. Let's just keep it to what happened in the policy today, what was said in the policy today. My sense is that CRR, certainly we are back to normal, so no more changes on the CRR front, and I fully agree with Madan that whatever has to happen will happen through the LAF, through VRR and VRRR going forward. The tone of the policy, started off being very pro-inflation and then kind of, switched over to a more, growth supportive kind of stance halfway through. My sense is that the CRR was also, cut was also a signal that policy will be easier going forward. And I think that's what we're expecting to see.
Okay. Mrs. Sabnavis, to you then for closing comments. And you did start off by saying that the depositors should at least know that at least no more hikes are coming in. What about the lenders? Do you think any lending cuts could happen?
If you look at the lending cuts, I think they're generally linked to the repo rate because you see a large part of the loans, especially given on the retail end as well as the MSMEs, they're linked to the repo rate. Okay, it's an external benchmark. So only when the external benchmark changes, which if like the repo rate comes down, automatically you'll get your benefit out there. Similarly, if you're talking in terms of the MCLR based loans, you need the deposit rates first to be calibrated downwards. So that will be a decision which banks will take depending upon the liquidity situation. So we need to know as to how this 1,16,000 crores enters the market, how exactly it has an impact on overall liquidity. That's how I think banks will take a call in terms of deposits. Because if there is surplus liquidity and you do not require to borrow bulk deposits, then it's quite possible that deposit rate cuts could take place even before a repo rate is cut. Like if you look at the weighted average term deposit rate of banks, they've actually been creeping marginally downwards even without any policy action. So I think the market conditions will probably will drive the decisions on the deposit rate. And this will also vary across banks depending upon their own liquidity situation.
All right. Well, thank you to both of you, Mrs. Sabnavis and Aditi as well, for those wonderful insights that you've given to all our viewers. And it's always a pleasure to host you on Business Today Television to decode and to simplify what these policy decisions really mean for the average investor at large. Thank you so much for being with us.
Thanks a lot for inviting.
Thank
Bye
you.
to you, Sakshi, and bye to Aditi.
Thank you so much. With that, viewers, we'll wrap it up on that. I hope you've got to know what exactly has really taken place when it comes to the RBI policy decisions today. How is it going to be really impacting the overall economy with the kind of decisions that have been taken? What does it really mean for depositors and the borrowers at large? And also, one has to really keep an eye out on the risks that the governor has continued to point out, inflationary risks that continue, external risks that he's also pointed out as far as the growth projections are concerned. But we'll have to see how we navigate through these tough times going forward. Everything will be on a wait and watch mode. But for now, it's coming on an expected line with the no repo rate cut, but some CRR relief that's coming into the system, which actually means that the kind of deposits that the banks were holding on to and they were probably clamoring for more deposits to come in, and they were hiking the deposit rates. That may actually have to stop, because now they have this additional 1.1 lakh crore rupees into the system, and therefore perhaps more lending also could be coming in. We'll wrap it up at that, but do stay tuned. There's a lot more for you to really look at. We will be coming back for another edition on Market Today to help you understand the closing action on the D Street on Friday.
Since the last MPC meeting, financial markets have remained edgy amidst